Hi, and welcome to the Coronavirus Freight Market Update for May 26, 2020.
Welcome, everybody.
Welcome back. Kevin Hill with Michael Vincent, as always, and this will be the last edition of the Coronavirus Freight Market Update.
Yeah, it will be, right? I mean, since we started this, I always talked about, man, won't it be nice to have the last one so we can move on to happier times, and we're getting out over it and start to recover, and here we are.
Here we are. So starting Thursday, it will be the mid-market,
Midday market update.
Midday market, yeah. Midday market update. Sorry about that.
Yeah. It'll be great, right? And as always, it'll remain an interactive show. So hit us up on FreightWaves LinkedIn and Facebook. Get your questions, comments out there. We'll read those questions and get them answered as best that we possibly can. So I'm excited about this being, let's moving on, right? I think that's what we need to do. Focus on the positive, the recovery, economic recovery, and bringing to light all those changes that occurred and keeping the positive ones, right?
Exactly right. I'd rather talk about the freight markets, and of course, the subline or subplot of that is going to be the economic situation that we're in and coronavirus. But we'll be talking more about the freight markets and what's going on, and what's driving demand and supply.
Absolutely.
And all of those good things.
Speaking of moving on, did you watch the match?
I did. I watched most of it. It was really exciting.
It was.
It was.
So the highest, the most viewers on a for a golf event.
For a golf event, usually I guess they draw about 4 million viewers, and I think this one had 5.2 or 5.8 million viewers, and it was, of course, if you're not familiar with it, it was Tiger Woods and Tom Brady. Tiger Woods and Peyton Manning versus Phil Mickelson and Tom Brady.
And Tom Brady, yeah, that's right.
It was great. The first 9 holes were in a monsoon, it seemed like. And,
yeah, they were.
And the final 9 were quite fun, entertaining. Everyone was mic'd up, so you got some really good insight
fun stuff.
To how Tiger and Phil approached the game, and a lot of really good trash talking as well, which is always lovely. And they raised $20 million for charity.
Yeah, exactly. Yeah, it was really good. Yeah. You got to see Tom Brady split his pants on TV.
You did, yes. I heard the golf
Poor
course.
Guy.
I know.
He was all over the place. He hits one good shot.
One good shot and splits his pants. But I think the golf carts went up for $50,000. It was the opening bid, because they're auctioning off all of the golf carts.
They were.
Opening bids were $50,000. So we'll see what they actually sell for once we get down that line.
Yeah, it was pretty cool stuff.
It was really cool stuff.
Looking forward to more of that kind of thing.
I hope everyone had a very safe and thoughtful Memorial Day weekend. And we all got a chance to take some time off.
Yeah, absolutely. Who we got on the show today, man?
We've got
a good show.
We have the Supply Chain Ninja.
The Supply Chain Ninja, Derek Mizysak is how he says you pronounce his name. I would say Smith, but Derek Mizysak. And then John Gallagher, who is our Washington correspondent.
Talk about some regulatory and legislative type of things that are coming down the pipeline, some weight and size limits and hours of service. So we'll be talking about that.
Be good.
And then, as always, we have Andrew Cox, who will be doing the news headlines here, one of our research analysts here at FreightWaves, and then our director of Freight Market Intelligence, Zach Strickland, the Sultan of SONAR, and then our lead economist, Anthony Smith, to break down some economic numbers as well. So let's kick it off with what's on FreightWaves.com right now on the news headlines. What do we have in that area, Andrew?
Yeah, Kevin, the first story comes from Greg Miller. He has been writing about import volumes for the last few months. They have been on an absolute roller coaster ride. As we've seen, there's been a lot of blank sailings throughout the last couple months, and they equate to about 20% of the capacity for the month of June and May that have been taken offline. And there is some starting to see some good news out of the container ships. Like I said, there's about 20% of the capacity for May and June that have been canceled, but it now seems almost certain that the carriers will not extend the same level of blank sailings into July and into August. Carriers had previously canceled about 10% of the July capacity, and there hasn't been really any additional blank sailings since that time. This has been about 2 or 3 weeks now. To the contrary, actually, ocean carriers have been adding back some of the canceled sailings from China to the U.S. West Coast. And the carriers are, if carriers were continuing to plan putting out the blank sailings into July, we would have already heard about it. They usually make these announcements 4 to 6 weeks out. And really, this is a positive sign for the U.S. economy and the recovery, with two really important caveats. One, of course, being the upward momentum could be halted by another breakout in cases, which could be possible. And then the second one is, despite these recent green shoots, the number of unblinkings, that is the number of sailings that have been uncanceled, don't really equate. They're actually negligible to the amount that have been canceled. So all that being said is that import volumes will remain depressed throughout May and June before picking up thereafter.
Yeah, Andrew, I was reading through that, and it was, I think it was a total of 6 unblanked sailings between the Alliance and Ocean Alliance, correct?
Right. There was 4 from I believe, that's coming straight from China to LA.
Yeah, and it's interesting. And when you say, it's good news that there aren't additional blank sailings, Kevin, as Andrew was saying, through June and into July. To give why that's so good is, once you get into July, it was only 2% of the capacity that was closed, right? So it's not like they canceled 30% and they're just leaving it at 30%. Right? It was only like 18% sometime mid-June, and then it drops to like 9% or 7%. And once you get into like July, mid-July or end of June, you're into like only 2% canceled or blank sailings, right?
Yeah, you see those 4 weeks of July, the capacity really rises towards the back end. It gets almost all the way up to full capacity into the end of July and into August. So that's basically the ocean carriers expecting things to be somewhat back to normal at that point in the year.
Yeah, because there were 2 things that were very positive about this, right? And one of them is the fact that we're saying that they're seeing additional bookings, right, or additional demand, and the fact that their blank sailings and their attempt to shore up the pricing levels has actually worked. They're up 28% over last year, right?
Yeah, they've done a really good job controlling costs and making sure that they can keep their prices up. That's been the main the main push for them to be able to cancel these sailings out, is to make sure that they can maintain pricing throughout this, and they've done that.
Excellent stuff.
It is.
How about air cargo? We hearing anything in air cargo?
Lufthansa and the German government. What's going on with that breaking news, Andrew?
Yeah, Kevin, after 25 years of privatizing the company nearly a quarter century ago, Deutsche Lufthansa AG has gone into an agreement with the German government to receive some funding while giving back some equity. So the airline group, which includes 3 major airlines, which is Lufthansa, the Swiss International Airlines, and Austrian Airlines, they agreed on Monday to a €9 billion bailout package, in which the German government will receive a 20% stake in the company in return for 2 board seats and veto power over any hostile takeover bid. The deal, which was designed, of course, to preserve the jobs of the workers there at Lufthansa, still needs to be approved by the European Commission and Lufthansa shareholders. And this deal comes after weeks of discussion with the German government. And during this time, the airline has done many things to try to cut down on costs. It has slashed 95% of its flights, something we've seen American Airlines do as well. They've asked people to take fewer hours and asked them to take unpaid leave, as well as decommissioning aircrafts and cutting some ties to operating third-party companies. They're doing a lot to try to cut down costs. This is by far the largest bailout that any airline has received across the world. Some American companies have received pretty large ones. Delta received $5.4 billion, and American Airlines received $5.8, but that doesn't quite top the $9.8 billion that Lufthansa got just yesterday.
Those deals with American and Delta also, Andrew, that didn't, there wasn't any type of equity share or anything like that, like this deal is talking about, right?
Correct. There was no equity exchange.
Kind of gives you an idea of the condition of airlines right now. It's probably going to be a 2-year at least kind of recovery, and you start going out with $10 billion. We also had another story, and I think we'd heard that this was going to happen, but LATAM, the South American airline, officially declared bankruptcy. Isn't that right, Andrew?
Yeah, they joined a couple others. Avianca Airlines has also declared bankruptcy. Just B, the kind of cheaper airline in the UK, didn't quite file for bankruptcy, but ceased operations. So yeah, it's an ongoing trend. It's a really rough time for the airlines.
It is, and it potentially spells issues for recovery, right? In the supply chain, is 60% of the air cargo capacity is belly freight, right?
Yeah, that's right. I mean, the transportation providers really want commercial airlines, passenger airline flights to get up and running again, because as you said, most of their capacity does come from belly cargo.
Andrew, let's pivot over to trucking and YRC. What's going on with the pension health benefits on YRC?
Yeah, YRCW employees are starting the third week of their health care being paid for by the Teamsters benefits provider as if they were out of work, even though not all of them are out of work. So on May 8th, Team Care, which is an operating unit of the Teamsters-affiliated Central States Health Fund, told the Teamsters in a memo that YRCW was delinquent on paying their health contributions owed to members that had worked during March. And that memo was released at the same day that YRCW had released a suspension of benefits to their active YRCW members in that health fund that I just spoke of. And except the benefits weren't suspended. The YRC, or the Teamsters, that is, stepped in to cover the benefits in a layoff package for these people, even though not all of them had been laid off. So the Teamsters has stepped up and started to provide for those YRCW employees.
Well, that's good news that they stepped up, right?
It is.
What does this indicate, though? Does this indicate that they have some confidence in YRC's future and the coming back of LTL?
Well, that is what was written in the article. They are expecting for this to last about 6 months and for things to become back to normal. They says YRCW has not come forward with a plan for repayment to the fund yet that they deem acceptable, but they are hoping for and expecting the business units of YRCW to kind of shore up and be better over the next 6 months, and that they'll be able to pay them back sometime later in the year.
Sounds like the Teamsters will have some bargaining power.
It does, and it kind of goes along with the PPP loans, and there's some updates on that from John Kingston out on FreightWaves.com. What do we have on that, Andrew?
Yeah, Kevin, the Small Business Administration made a release on Friday with the intent of clarifying some of the rules of this Paycheck Protection Program. Sorry about that. Unfortunately, while it did clear out some of the aspects, it left a lot of them still uncertain. There was one point that it did drive home, and that was for those who received their money early on, it is going to run out very soon. The primary purpose of the clarification issued by the SBA was to reiterate earlier interim rules about the qualifications and payback provisions of the PPP, which was designed, of course, to allow companies to keep people on the payroll throughout this COVID-19 lockdown. And as the SBA released the rule on May 22nd, the eligible costs covered by the PPP were to compensate for 8 weeks of payroll expenses. So if you do some math, those who received their disbursement on April 3rd, which was the first eligible time period, the 56-day period would run out later this week. So they were trying to reiterate that those who receive their money are going to be running it out soon. And the approval process for loan forgiveness is to ensure that the program's funds were used to meet the goal of the program. That was to keep people on the payroll. The rule is that they had to make sure that 75% of the money went flowing into the workers' hands.
So if I'm reading this correctly, Andrew, and understanding this correctly, they submitted plans through paperwork in order to get the loan, right? And now they've got to go through the process to prove that they actually adhered to those plans.
That's exactly right. Yeah, the process went, they applied for the loan, they were either approved or denied for the loan. Once they received the loan, now that they have used up the loan's funds, they have to go back to the bank and ask for forgiveness of the loan, prove that they used the money to keep people on the payroll and not to do other types of whatever capital expenditures they would do. And that would be the way that they are then, they don't have to pay back the loan.
Yeah, like buying diamond rings and stuff like that.
Arkansas Mo. Pulling in Arkansas Mo.
Exactly.
Yeah, to do that. But yeah, the PPP is kind of that ending period, that 8 weeks period is coming due right now. So it's time to go in and document and prove that you used money wisely and not have $80,000 and $8,000 in his pocket. Arkansas,
something like that.
Whenever the feds came in.
So Andrew, does this mean that there's no talk of extension or anything like that? So are we confident we're in the recovery throes and they're not going to need the PPP to keep people on the payroll and keep the recovery going?
Well, I think it's going to be a discussion that is ongoing for the next few weeks. I mean, I think we're going to have to see if there's another case outbreak. I think we're right on the cusp now of we look 2 to 3 weeks out whether or not we really feel confident we're over this. I mean, there was a lot of, you saw the news this weekend of people out, partying and having a good time without any masks. So we will see the repercussions of that in a couple weeks.
Yep.
Thank you very much for the headlines today, Andrew
Thank you,
Cox.
Andrew.
And as always, you can read these stories and much more on FreightWaves.com. And now let's turn to the trucking market, the freight markets. SONAR, and Zach Strickland, our Director of Market Intelligence here at FreightWaves. What's the good news today, Zach?
Leading into Memorial Day, we typically see volumes kind of increase. There's a bit of a surge approaching the holiday as shippers really push a lot of freight out. Last year in 2019, we really didn't see this impact like we normally do, like you would normally expect. Last May, we've talked about it. Last May was pretty disappointing in terms of freight market activity and volumes. We had this big trough of OTVI in the middle of the month, and it really wasn't, it didn't have that big, robust recovery that you normally see leading into June and the summer peak season, if you will. Well, this year, those volumes have recovered well beyond 2019 and then even a little bit further. So before the holiday, OTVI hit almost 100 or 10,500 on the index, which was higher than the summer peak last year. So freight volumes do appear to be in recovery mode. Now, they did fall off, of course, due to Memorial Day holiday. But again, even then, the Memorial Day holiday year over year, we're still seeing pretty strong year over year growth at a pace of about 3 to 4% per week.
So, Zach, I mean, we talked about the tender lead time last week and what those possible implications were for that and volumes coming into this week. Have we seen anything? I mean, over the week, you usually have that weekend kind of flatten, right? When you go over, and especially now with the holiday, you see that big drop, obviously yesterday and over the weekend because Memorial Day. But is tender lead time showing you anything?
Yeah, so lead times, we talked about it a little bit last week. Lead times were actually really flat. They weren't as high as you would normally see because a lot of shippers, again, start pushing freight out in advance of the holiday. They have a lot of preparations. Well, this year, the tender lead times did not spike significantly until literally 2 days prior to the holiday weekend, which you normally see about a 5 to 7 day lead in to a holiday with lead times increasing pretty dramatically. This time they only increased on Thursday, Friday. So basically what we're seeing is shippers are taking, they're definitely pushing freight out faster with less heads up. So it means that they're probably reacting to, increasing demand on their end with shorter heads up in order to get this freight out. So this to me is a pretty positive sign for any carrier out there. Again, it's also going to have this contraction of capacity impact as people are pushing freight out more on demand, more just in time, just pushing orders out rapidly. So that's going to lead to less planning potential, which will drive spot market rates up effectively, and then eventually the rest of the market will follow.
Zach, I have a question here from a Facebook viewer, and has a question about Atlanta. He's saying that there's a lot of freight in Atlanta right now, but it's not really paying all that well. What do you see in the Atlanta market right now?
Yeah, no, we are seeing absolutely a tremendous increase in freight volumes coming out of Atlanta right now. It is not translated again yet. It's going to take a while for it to translate to any significant spot market rate increase. What we're seeing right now, there's a very big disconnect between volume increase and tender rejection rate increase. Our tender rejection rate right now, which is kind of a proxy for the spot market activity, is still around 4.5%. So we're still not quite where we were at this point last year in terms of tender rejection rate, meaning that spot rates don't expect to see a huge amount of tightness on the spot rate side just yet. But if volumes continue on this path, I think it's inevitable, especially seeing as a lot of these trucking companies may have reduced fleet size or left some drivers off the road as volumes died in April. It may take a little bit more time for capacity to return, but that being said, tender rejection rates being as low as they are right now on Memorial Day week, which is a very heavily vacation time period, makes me think that a lot of these carriers and drivers, may have stayed on the road and not taken their vacations like they normally would. So again, maybe they just thought that April was the vacation month for them as all those volumes fell off a cliff, and they're just happy to be back on the road again.
Yeah, you're exactly right. I was just thinking that the drivers are not going to take the time off. If they're going to get loads, they need that money, right? And they need to keep it rolling and keep hauling freight to keep themselves afloat. And then you have, but as the recovery goes, and you said, we're 4.54, is that what our outbound tender rejection is right now?
Yeah, about 4.5%.
About 4.5%, and that's not even above last year's, which was not putting pressure upward on spot rates itself, right? So, unless we see capacity starting to tighten through volumes continuing to increase or capacity itself going away, do you see any trends that would make you believe that spot markets are going to go up, pricing would go up in the next month, 2 months, 3 months? What's your thoughts on that?
Yeah, I mean, if the volumes continue to rise at the rate that they are, it's inevitable that we will see spot market tightness. We are already seeing rates increase. They're just not increasing rapidly.
Right.
So you're going to have these little isolated pockets. Like I said, inevitably, if volumes keep going at this pace, it's going to have this natural tightening impact, and you will see a significant rise up. I think if we get higher than that 10,500 mark, that seems to be some sort of inflection point for the market to not be able to withstand that amount of volume as carrier networks become increasingly difficult to manage. But that being said, we're going to take a little bit of a step back this week as volumes cool down a little bit. Still, shippers are taking vacations, even though the carriers appear to not be taking as many vacations. It's going to be an interesting month, to say the least, in June as we approach the traditional summer peak here in about 2 to 3 weeks.
The other thing, Zach, is does refrigerated volumes have anything to do with Atlanta having a lot of volume there, or a lot of outbound volume and no pressure on rates because you've got the West Coast reefer coming in?
Yeah, no, that's accurate. There's definitely been a strong increase in reefer activity in the Southeast. Again, produce season is bumping on the West Coast right now. We've seen significant amounts of freight coming off the West Coast. Spot rates out there, of course, are driving up as well. So all that freight moves to the East Coast, flooding some of these, metro areas with the produce markets, et cetera, going off. So, yeah, we have seen some drops in the reefer rejection rates for Atlanta, which typically does get a little bit tighter this time of year, especially as carriers are starting to press more freight out, into the West Coast. They're trying to go and cover a lot of that good paying spot market freight.
Thank you very much for that freight market outlook, Zach, our director of Freight Market Intelligence here at FreightWaves. And up next, we have our lead economist, Anthony Smith, coming in to talk about, I think we're going to talk a little bit about consumer confidence and a few other economic data sets that dropped over the weekend and late last week. How are you doing today, Anthony?
Kevin, I'm well. Thanks for having me here. But yeah, you hit the nail on the head here to talk about some of the consumer conditions and some of the latest data releases. As of this morning, we just got new updates for the Consumer Confidence Index by the Consumer Conference Board, and we saw that it edged up slightly. So I believe the latest reading showed that there was an 86.6 from the previous reading of an 85.7. So a small nudge, but it's an upward movement nonetheless.
What is a good number? What is a number that you would say, consumer confidence is high?
So it's all relative. So, I mean, we saw drops in the 10s. So this number was hovering in well into the 100s just a few months ago before the coronavirus pandemic. So we saw numbers of course, 101 and higher. So those were respectively good numbers. So now that we see this huge drop into the 80s, I mean, that was pretty telling for the current conditions of what's going on in the country. But now that we start to see that free fall start to stop and upward movement here is really telling that consumers are starting to feel more confident about the outlook of the overall U.S. economy. Not to say that everything is rosy and everything is fine here. The report did outline in detail that consumers are feeling a little bit concerned about future financial prospects. And I think the big concern here around a lot of the recovery is any kind of potential of a second wave with the corona pandemic.
Yeah. Speaking of confidence, what about housing sales?
Yeah, so housing, new home sales also increased this month. I believe it was a 0.06 increase for this month. So that was really telling, and that kind of talks to what's going on right now within the economy. It was an unexpected rise for many, but we were expecting housing, construction, and manufacturing to be one of the first segments to come back online, especially with such a demand for housing towards the latter half of 2019 and going into 2020. So the thing with housing is that there was already a tight supply There was a tight inventory, so there was a huge demand for homes. And so this was one of the reasonings that we were expecting housing to be one of the first portions to come back online. Now, the other thing is that this is still well over 6% below the year-ago level, and we have to look at what time of the year it is. This is the spring month now, and so once we get into the spring month, that's usually the busy building season for a lot of home builders. The other big part of it is that many homeowners or home purchasers are starting to look at maybe larger homes. Home builders are going to like this. This is going to be a little bit more better for margins for them. Previously, we saw that there was a huge demand for entry-level homes, so this might be shifting a little bit more depending on where some people fall on the spectrum on being able to make some of these bigger home purchases, as opposed to first-time home buyers who might have gotten hit very hard throughout this entire pandemic.
Right. So this is specifically new home sales, right, Anthony?
Correct.
So what about new home starts? Do we measure the new home starts and building permits, that type of stuff? And if so, when does that information come out?
Yeah, so we had housing starts come out last week, so this is going to be the latest iteration for our more recent housing data. Although we're looking at housing starts and new homes, that's going to be a smaller portion of overall housing and construction. We're looking at existing home sales. That's going to be well over 85 to 90, upwards of 90% of the overall housing market, and so that's going to be a much more substantial market. But with so many shelter-in-places and effects still, many people still worry about maybe having individuals in their home, open housing, things like that might slow down that market for existing home sales, and that might really start to limit the inventory there as more people take their homes off the market. But that's going to be all region by region and state by state basis, depending on what kind of measures are being put in place there and what the overall outlook is within that particular city or that particular region. We're looking at existing home sales. That was something that was already tight as well. We're looking at inventory, and that's where many first-time home buyers are going to looking to make those purchases, because they're typically lower priced, but with new home sales, they're usually going to be a little bit more higher price, and typically not first-time home buyers are going to be buying these new home sales. So it's an optimistic look to see that these are starting to increase, but definitely one of the trends to watch closely. Again, this is a busy spring building month. Home builder sentiment is up, and so home buyers looking to still be active in this spring season.
We pivot back to manufacturing and industrials. On economic releases, when do you think we'll be able to measure and gauge that in the coming weeks? What reports should we be looking at to gauge the recovery in manufacturing?
Sure. So we just, I believe, had the latest report from the Dallas Federal Survey Index came out, I believe, earlier, either this week or late last week. So that's one to watch, those regional Fed surveys. Something to come out this week is going to be capital good orders. And so looking at non-defense capital goods new orders is going to be a good indication of where business sentiment is. This is one Vincent and I like to chat about at all the time to kind of see where production is and how things are moving along within manufacturing. So being able to look at those non-defense capital goods new orders to see what's happening with business-to-business activity, I believe that's going to come out Thursday morning, and that's going to be one to watch closely.
Yeah, that'll be a strong indicator. That's one of the lead indicators, as you've spoken about on freight forecasting with myself a number of times, is that, and then industrial production and flatbed, right?
Correct. Yeah, I mean, we're looking at manufacturing. One of the first things that we knew was going to happen is going to be the flatbed operators going to get hit hard, knowing that manufacturing was already on the outs, that business investment was already shaky throughout the latter half of 2019, and that the trade tariff wars really made there be a lot of uncertainties within the marketplace. Knowing that the coronavirus really ramped up these uncertainties, it really kind of created this environment that would put manufacturing that was already on shaky ground in a much more vulnerable place. And so we've seen that. Now, businesses are going to be hesitant to make those investments, I think, in the coming months without some kind of incentives, whether that be tax breaks or any kind of interest rates. Now, there's not much movement that we can do with interest rates, but there might be some movement we can do on the tax incentive sides.
Thank you very much for the economic outlook,
Thank you, Anthony.
As always, our lead economist here at FreightWaves, Anthony Smith. And now we turn to our next guest.
Yeah,
that
the
is
supply
coming
chain
on.
ninja,
The supply
Derek
chain ninja.
Mizysak is. Do we have him on the line? I think we do. So he's with us via Skype, right?
I believe so.
Are we
Can
doing?
you guys hear me?
Yeah,
We
I can hear you.
yes.
I can hear you, Derek. How are you?
Doing well. How are you guys?
There he is. I see you up there. So where are you at right now? Where is a home base?
Home base is Atlanta, Georgia right now for me.
Oh, okay, great.
And, yeah, not too far down the road from you guys.
Great. Did I pronounce your last name correctly, Mizysak?
It's Mizysak, but it was close enough. I've had much worse.
I bet you have. I bet you have. So, the supply chain ninja, right? That's your moniker, right? So,
Yes, sir.
So what are you seeing as far as these challenges? We're definitely seeing uptick in truckload volumes. You just if you've been listening and reading FreightWaves, we're reporting and talking about a very small amount of unblanked sailings, but blanked sailings. So what do you see as the current challenges that in the supply chain right now as we're moving forward? And give us a little bit of that. Is he not hearing me?
I don't know. Can you hear us?
Yeah, I can hear you.
Okay.
They're saying I need to turn the show off. I don't know which button that would be.
Oh, yeah. Okay, I got you. But if you didn't hear the question, so the question is, what are you seeing in the supply chain challenges given the state of our recovery right now? It is looking good. You've got air cargo capacity very, very tight. Obviously ocean tight by blanking sailings on purpose, but now they're starting to unblank some of those sailings, right? So what are the challenges that you're seeing in the supply chain right now, both domestically and internationally?
Yeah, I think first off, it depends on kind of what market you're sitting in, right? So where I currently sit, I'm in a CPG space, and a lot of our stuff is soaps, cleaning items, and those things. So as you can imagine, we are in a good position where we're trying to kind of keep up with the demand. Whereas if you're in another organization, if you're making some sort of outdoor things, if everyone's on lockdown, you're overproducing, right? So I'd say through the lens of the organization that I'm in right now is really, really understanding how we are keeping up with the demand and developing more of a long-term strategy that, God forbid, something like this happens again, we have the opportunity to kind of flex and do some sort of last minute agility planning, where this is something going forward. You talk about the new supply chain in the future. It's not something necessarily anybody would have had to have put a ton of stock in, but going forward for sure, definitely will be being more planful with those risk mitigating activities.
Thank you, Derek. So what's one of the biggest lessons you've learned in basically the stress testing of supply chains? What do you think is the number one item going forward that will be adjusted?
I think from what I've experienced, I've been at two organizations through COVID now, and in both of them, it's really highlighted the need for being tightly coordinated with your functional partners through some sort of sales and operation S&OP planning process. I think the COVID pandemic has, you guys give daily updates, things are changing daily, weekly. You need to really stay tight with your partners, finance, marketing, sales, manufacturing. Everyone needs to be on the same page and knowing what's going on. That's kind of always been a best practice, but I think the COVID has certainly raised the awareness and need for a stronger planning process where everyone has a platform to collaborate on what's going on.
Yeah. So being in this space, and you talked about it depends what market you're in, right? What is your vertical? What is your space in the world as far as the supply chain challenges go, right? So one of the things that strikes me is the organization you're with right now. So it would be really aligned with PPE, right? Or sanitizers, that type of stuff, soaps, that type of things, and would be susceptible or have a strong say or opinion on the idea between just-in-time versus just-in-case supply chain in the future. What are your thoughts on that?
I think that's a big question right now. You got folks at both ends of the spectrum. Some folks are saying that the just-in-time methodology is going to go almost out the window, and we're gonna see stockpiling of some sorts. I think again, it goes back to the industry you're in. Stockpiling is not necessarily a general good inventory management technique, especially if your products are susceptible to spoil or expiration. And a lot of companies, I mean, extra inventory on the balance sheet is money tied up, not being used elsewhere, right? So I would venture to guess that just in time is still going to be, kind of a best practice, and it's not getting crumpled up or thrown out. What I would hypothesize seeing is that there's going to be more work done behind quickly scaling demand up or down, right? And so maybe you keep a little bit of extra safety stock, but by no means will you be carrying 5-10x of toilet paper to meet demand that happened, once in 100 years potentially. So I'm still on the side of the just in time, keep it at a good level. I mean, at the end of the day, there's certain things you can't plan for. No one planned for COVID in their forecast, but we either up or down, and we're seeing it right now.
Derek, you mentioned scaling up and down production and the source of production. On a scale of 1 to 10, how aggressive are companies in changing how they source, or maybe moving out of China, or looking at different geographies, offshoring, nearshoring? On a scale of 1 to 10, how aggressive are companies right now?
From what I'm seeing, I would have to put it kind of in that middle range, that 4 to 6 maybe. I think right now everyone's just trying to get through this. They're trying to do what they can to get through it. Depending on the market you have, you can't just swap providers and keep going within a week or something like that without possibly disrupting the business. So a lot of folks, from what I'm seeing, are kind of heads down trying to get through this, and then there's a lot of parking lot to-dos that are becoming, hey, how do we take a better look at our supplier scope? Do we look at doing nearshoring or reshoring? But the one thing that isn't coming up a ton is that lifting and shifting a supply chain and compressing it is not something that you just do, like you're ordering at McDonald's through the drive-thru. It's something that takes time, takes money, and it could definitely disrupt the business. So I think once we get through this to our new norm, that will determine how the level of appetite for an organization to cut a check that would result in having to invest in moving a supply chain. So
that's excellent. So transparency, you mentioned transparency, staying tightly aligned with your suppliers and having this flexible supply chain, right? So what are some of those, what are your thoughts on some of the innovations and the touchless, even at pickup and delivery at the DCs, and even within the four walls, some of those changes that you see coming as we pull out of this?
Yeah, I mean, one of the things that's a concern is, with something like COVID that is changing so quickly, how fast can we get those demand signals back upstream to our demand planning, supply planning folks to make sure that we are producing at the right, interval? Problem is, some of the lead times are, call it, 90 days, 120 days out at best. So your decisions that you're making based on demand today, that's moving, you're already, 3 months out, call it at best. And so when you get closer to the within the four walls, from an innovation perspective, it's really, again, getting that visibility to what's going on in the market. You guys talk a lot about, the carrier and the freight side of things. That's not necessarily something that's always very strong upstream for a shipper in terms of like industry-wide understanding what's going on, unless there's a little bit of an interest to stay up to date, right? Typically, you kind of have your dedicated lanes, your carriers, and you deal with the fires that arise there. But I've always found an interest and passion of understanding, which is kind of why I've taken a liking to you guys, because you guys do an awesome job of kind of laying it out there for everyone to see what's going on.
Appreciate that, Derek. Appreciate that very much. What do you see? Do you do a lot of air cargo in your supply chain?
So air cargo is typically kind of one of those last results.
I got you.
When you're not trying to, it's something usually that has to get approved, I guess you could say.
What do you think one of the biggest innovations with demand planning will be because of this crisis? Do you think there'll be really good tools that are created from this experience coming down the pipe in 3 to 5 years?
I think the tools are definitely out there. There's a lot of kind of startups that are providing, demand sensing sort of software that can kind of give you really at a moment's notice to shift in any of your normal planning. I think it's going to put more pressure on that forecast accuracy and more pressure on making sure that, hey, organizations, we need to be doing more than just potentially manually calculating forecasts. We need to be relying on some sort of a statistical forecast, and we need to, make sure that we are, kind of raising the bar and getting higher in certain aspects.
Excellent. Derek, really good information. Thank you so much for coming on the show. Really appreciate it. How do people reach out to you, the supply chain ninja?
Yeah, I mean, my main domain, dojo, if you will, is really LinkedIn. So you guys can reach out to me on LinkedIn, and happy to connect and collaborate. The supply chain ninja piece was really just kind of taking a fun approach to supply chain. You find a lot that there's a lot of really, I don't want to say uptight, but there's not a lot of comedy in the supply chain space, and that's kind of what I try and serve up with my content and the little kind of So it's a good lane so far. Worked out well.
That's great. Well, I really appreciate it, Derek. I'd love to have you on again sometime if you'll accept the invite. It was really informative. Thank you so much, my friend. Have a good day.
You too, guys. Take care. Thank you.
Thank you. This is interesting. Very interesting to hear, to talk a little bit more about the demand side too, because there's always an issue with all supply chains is forecasting demand.
Well, yeah, if you're just in time, you've got to be really skilled at that, right?
Yeah. And even if you do carry inventory, you have to be really skilled at it.
Oh, yeah.
You have to be really skilled, and it's one of the hardest things to do.
Yeah, no, there's absolutely no doubt. It becomes very, very difficult, and obviously he talked about it. Transparency, knowing about what's going on right now is extremely important. But then when you're looking at, what do you say? Like you're 60, 90s, 120 days out, right? And you're trying to schedule for that type of demand. Right now, you've got to really be paying attention to all those macro and microeconomic conditions and housing starts and production orders and all that type of stuff, right? To kind of know what is happening. And is Lufthansa going to be around for me? Is, the Alliance going to have enough bookings or, slots available on their ships for me? That type of stuff. But very good stuff.
Now joining us via Skype is our very own John Gallagher. He's a Washington, D.C. correspondent for FreightWaves, and we're going to talk about regulatory issues and legislation in the trucking world. Are you there, John?
Yes, I'm here.
How are you doing today, John? Good.
I'm fine. I'm fine. Thanks for having me on.
You bet.
Absolutely. Welcome, John.
You have an article out right now on FreightWaves.com, and it is about size and weight limits, and that discussion is percolating once again. Can you fill us in on some of those details?
Yeah. So what happened was that because of the changes in some of the state size and weight laws, that have basically loosened those, especially the weight laws that have allowed increased weights for trucks. Some of the opponents, the long-time opponents of the truck size and weight increase issue, are kind of a little concerned that those will stay in place after the pandemic goes away. So the ones that are the proponents of the measure actually are kind of taking this opportunity to try to push those. So the whole issue is kind of heated up again. The LTL carriers, represented by a group called the Americans for Modern Transportation, they're a big proponent of that because they say, increasing the double trailers from 28 feet to 33 feet would drastically improve efficiencies and productivity. and opponents, safety advocates have been opposing this for years, as have the truckload carriers as well as the railroads. So again, it looks like this pandemic might be one of these opportunities for another issue like this to heat up again. It looks like it's happening.
So that's interesting to me. That, I mean, the two sides, as you just defined them, is you've got the LTL carriers out there that want to take their pups from 28 to 33 feet and essentially gain 10 feet on a doubles load, right? And then the other side, it's against it, are the roadway, or not roadways, but the truckload and rails,
yeah.
Right? Because obviously they would pull freight from those, right?
Right. Well, and plus, one of the big reasons that the truckload carriers are against it is because it would mean a big investment for them in those types of equipment to compete with the LTL guys. And they don't always compete directly, obviously, but there is that section where they do compete with each other. So they see it as this basically being forced to put in this major investment in the type of equipment that LTL carriers already have in place, basically. And then the railroads, they're opposed to. They don't want to give an inch on anything that might increase competition. So they've been against it as well.
Where do you see this? Is it going? Is it anywhere close to? Is it just percolating and no real action as of yet? It's just chatter.
Yeah, so far, I'm going to be monitoring it because it all depends on how things shake out with the pandemic and where a lot of these issues might come up in a potential infrastructure bill where you can put in some of these proposals in there. So it's going to depend, but right now it's kind of just like in the initial stages, I'd say.
Right. Yeah. So John, right now the easing of these regulations, like the weight, like we talked about, right? They increased the weight, and was it not just for specific commodities, right? They said there had to be, it couldn't be a nominal amount of PP, or it was considered essential goods, right? On those loads for those weight limits, or was that just the hours of service?
Yeah. Those are more on the hours of service.
Okay. So these weight limitations, they are set to expire, right? They're not. Aren't they set to? There's a date for expiration in these, where it's not in danger of just ignoring it and they go on forever, right? There is an expiration date that they'd have to argue, right?
That's right, and it's kind of it's coinciding basically with the national emergency that the president put in place. Which keeps getting extended as this pandemic kind of rolls out, or as we see the pandemic come through. So these there are, and a lot of it's a state by state thing, but generally the states are abiding by the national emergency order.
Gotcha.
How about you have an article on safety scores, basically safety ratings, and what's going on with the discussion about those?
Yeah. There was one of the. It came out last week. The FMCSA issued this order. It's titled "Guidance on Leveraging Technology to Conduct Compliance Reviews," which the FMCSA, from what I understand, they've been doing this for several years now. Anyway, they've been doing off-site reviews because of the way the technology has been evolving in the last several years. A lot of these audits and compliance reviews have been done, have been gradually going to off-site versus on-site, because it saves the FMCSA money, staffing, and it's easier for the carriers. The carriers have the ability to file these, the information that the FMC is asking for electronically. But what came out last week was that even though in the regulations it say to do a compliance review, part of it has to be on site. As long as this national emergency is in place, that's eliminated. So you can conduct all parts of the compliance review and audit totally off site without having to be visited at your place of business by an investigator on site. So the importance of that, I guess, is the FMCSA is relaxed several restrictions, over the last 2 months during this COVID crisis. For example, they required violations to be reported to FMCSA within 30 days. That used to be a requirement, but that's no longer required anymore because of the social distancing. So I guess the importance here is that carriers shouldn't think that just because the FMCSA has been kind of relaxing all of these restrictions that they will, and that just because they're not able to come to your place of business, don't think that these compliance reviews aren't ongoing, basically.
That's interesting stuff. What begs the question in my mind, John, and I don't know if you have the answer or not, is why the required on-site visit, anyways?
It's basically, from what I understand, Michael, it's because it's in the regulation.
Right.
But you're right. It's been evolving where it hasn't been. From what I understand, at least they have the FMCSA has the option to come in a specific case where they want to find out what's been going on if a particular carrier's had some really strict violations. So they always wanted that option to be able to go out on site. I think in like more serious matters, but more routine matters, they've been able to do it totally off site.
Yeah, but, I mean, they're not showing up and sticking a dime in the steering tire to make sure that it's the proper depth and checking brake calipers, right, on site.
Right, exactly. That's right. As these reviews can have some serious implications. I mean,
sure.
that basically gives your I guess like a month or two after they give the compliance review, you're issued a safety score, a safety evaluation of what is it, satisfactory, conditional, and unsatisfactory. And if it's satisfactory, obviously you're fine. But conditional, that you have a better chance of getting a roadside inspection, and that can increase your fines. And if you get a unsatisfactory score, you're basically that puts you out of service. And you have like a month to get back into compliance. So it's pretty important.
It sounds to me like this is some change that would stick.
I do too.
And not require the on-site.
Yeah, like to basically push them over into just because they've been going that way anyway, and it obviously saves the FMCSA a lot of money too.
Sure.
Well, thank you very much for your time today, John. And you can read about regulations, legislation, and the articles we just mentioned on FreightWaves.com.
Great, thanks you guys for having me.
Thanks, John.
Okay.
Yeah, it's interesting stuff. Especially the when he's talking about the truck size and weight limitations, right? Because you hear the different sides, and
you do. Yeah, you see that the same way with fleet size, right? You have the owner operators and the enterprise fleets are always competing with one another and using regulations and threat of regulation to kind of monitor each other.
The other interesting thing about that in that article that he wrote, and you should really check it out on FreightWaves.com, is the studies and the predictions on what would happen if they were to increase the size of the pups and the weight limit, right? Or the double trailers, sorry, from 28 foot to 33 feet, is the predicted cost for infrastructure maintenance that we have.
Yep.
Like 33% more cost, et cetera, due to the weight on bridges, et cetera.
It would, and basically never let a good crisis go to waste.
Yeah,
and
never let a good
LTL
crisis go to waste. Get something out of it.
So how about some good news now? Let's finish off with some good news, some charity works.
Let's do that. So what's good? So Dairy Max and Convoy team up to deliver fresh milk to food banks in Texas, right? FreightWaves.com. Article. You can go read it on FreightWaves.com. But Dairy Max, a nonprofit dairy council made up of 900 dairy farm families across an 8-state region, and Seattle-based Convoy, a digital freight network. We know those guys, don't we?
We do, yes.
Are teaming up to deliver thousands of gallons of fresh milk to food banks in Texas. We heard all about the excess milk that was being dumped as there were no schools or restaurants open to deliver to. Well, some of it's finding a home now.
It is, yes.
Good. We're finding milk a home, which is really good stuff. According to Jenny McDowell, director of the business development at Dairy Max in Texas, most families that use food banks receive an average of 1 gallon of milk per year, which is by no means enough to fulfill the nutritional guidelines that are recommended 3 servings of dairy a day. Convoy stepped up to help deliver the milk after announcing it was paying 100% of trucking costs for businesses wanting to donate to food banks across the country in mid-April. Convoy's program taps into Feeding America network of 200 centralized food banks and 60,000 local soup kitchens and pantries nationwide. Feeding America estimates more than 54 million Americans are now food insecure as a result of the pandemic, but this is certainly helping. In the past 3 weeks, McDowell said Convoy has distributed 26,000 gallons of milk supplied by Borden Dairy to mass distribution sites that are feeding thousands of people each day, including the State Fair grounds in Texas. Another 20,000 gallons of milk are expected to be delivered over the next week. So that's good stuff.
You know, it's really good stuff. I was blown away that families at food banks only get 1 gallon of milk per year, which is crazy. I think they're going to expand it to Louisiana, Oklahoma, Colorado, and Wyoming. So hopefully they continue with those expanding plans. And
move on and on and on and on. Like I said before, and I preach it almost every show, we don't need a crisis to be good to each other.
We don't.
Right?
We don't. So what's coming up on FreightWaves TV? So at 2 o'clock Eastern Time, myself and Andrew Cox will be doing Great Quarter Guys and talking about... We're going to talk about e-commerce, retail, the switch from brick and mortar to e-commerce, and what that means for malls. And
that'll be very interesting. You know, we talked about Target last week.
We did talk about Target.
Yeah, they've had some massive changes, right? And they're reacting to it. It seems like it. They're looking at downstream or post-store distribution, et cetera. Right?
We're going to be joined by Seth Holm, who is an expert at the retail sector. Used to work at a hedge fund, and that's what he covered. And then on tomorrow, on Wednesday, 12 p.m., put that coffee down. We're going to have Stan Duncan and talk about mental health and sales and kind of that balance between happiness. So how to be happy in life. And he has a great perspective. Stan Duncan has a great perspective on everything. So it's going to be a great show. And then at 4 p.m. is with SONAR.
2 p.m. is Freightnomics, right?
Oh, yeah, Freightnomics.
Freightnomics at 2 p.m.
I forgot about
4 p.m. is with SONAR. Yeah, and then we're back here for the
midday market outlook.
Excellent.
Update. I'll get it right.
So close. On Thursday, and then Thursday, 4 o'clock, freight forecasting. We'll be going through some numbers. Maybe we'll throw out some of the new macroeconomic data that comes out Thursday. It's kind of a slow time for that stuff to come up, so we'll be looking at that. Anthony may be on. It depends on if the numbers come out or not. And then Friday, What the Truck?
What the Truck, yes.
Yeah, baby.
Yes.
At noon. Dooner will be back.
Dooner will be back on What the Truck. And do you have any guests lined up for the truck yet?
I'm not giving it away, man.
Hey, that's good. You build up the suspense.
It's going to be even epicer, or whatever it is that we're up to by now.
It is.
No, it'll be tremendous. So we'll go through that on Friday. But yeah, it's nice that this is the close of the coronavirus freight market update.
We're retiring the name and going forward Tuesdays and Thursdays at noon, interactive show, and it's the midday freight market
You finally got it, so we can move forward with things. It's going to be awesome.
Midday market update.
Midday market update. All right, we got it straight finally. So we'll go through more things like the developments in air cargo and in ocean as well, which is very interesting because those things in moving forward, even as demand comes up, if you don't unblank sailings fast enough, or in the case of air cargo, you don't have that capacity come back fast enough, it can stall out or cause those hiccups and bumps.
And if you want to participate, if you want to be a guest on the show, Tuesdays and Thursdays at noon, usually our outside guests are at 12:30 and 12:40. Please reach out to us. You can reach me on LinkedIn at Kevin Hill, or email khill@freightwaves.com, and you can reach out LinkedIn.
Michael Vincent on LinkedIn, or Vincent at Vincent the Dude, or mvincent at freightwaves.com. So
Vincent. So catch us. Look forward to seeing you next Thursday.